Hi, welcome to the second section of this lesson. In the previous section, you have learned about how to calculate the return needed to achieve your financial goals. In this section, we will go through the asset classes that you can invest in. In today's modern world, there are 7 types of asset classes. The first one is real estate, followed by stocks and bonds. We will not be covering stock and bond in this section. They will be left for the next lesson because I need to spend a bit more time on them. The other common asset classes include foreign currency and commodities. Interestingly, you can also invest in rare items like antiques and arts. But due to my lack of knowledge, I will not be covering them in this course. Lastly, cryptocurrency is also considered an asset class, but I don't think they are a good investment for now. Please read my reason in the text below. So let's proceed to discuss about real estate. There are 2 ways to make money from real estate. The first way is to buy a house and hope it goes up in value. When you make money by selling the house at a higher price than you bought it, this is called capital gain. The second way to make money is through renting the house out and collect rent from the tenants. The rent is considered to be an income in this case. So you might be thinking, okay, now that I know about how to make money from real estate, so what affects a real estate price? Surprisingly, it is interest rate. When interest rate goes up, real estate value growth slows down. This is because when interest rate goes up, mortgage rate goes up as well, and this makes buying a house less affordable for a lot of people. And this means that when demand is slowing but the supply stays the same, this will cause the real estate prices to slow down and probably go down. But the inverse is true too. If interest rate goes down, house prices would eventually increase. So that's all I wanted to talk about real estate. We will move forward to talk about foreign currency as an investment. So how do you start with foreign currency as an investment? To be successful in foreign currency investment, you need to determine the interest rate difference between your country and the other country that you are interested in. Typically, you want to invest in a country where their economy is doing well and you expect them to raise interest rate faster than your country. Now, if the other country does in fact raise interest rate faster, their currency value will go up and you will make money. Let me give you an example. This year, 2018, the US decided to raise interest rate faster, but Europe decided to hold their interest rate. This caused the euro to drop against the US dollar for the first half of 2018. So why does this happen? Why does interest rate affects the exchange rate? It is mainly because of Europe investor wanting to earn better interest in the US. So there are a lot of demand for US dollar from Europe. This caused the US dollar to euro exchange rate to go up. When you invest in a foreign currency, you want to make sure that they are not going to print money. And this is what I call the money supply problem. When a country prints money, the currency loses value. This is because the total real value of a currency has to stay constant. You cannot create value just by printing money. If the total value stays constant, but the number of paper cash increases, due to money printing, the value of the cash will drop. So this means that the foreign exchange rate will go down. It is a little bit confusing and maybe a little bit hard to understand. So just remember this. If a country decides to print money, it's best to avoid their currency. If you decide to invest in a foreign currency, it is likely that you will use a forex trading platform. Now, forex trading platforms allows you to do leverage. And leverage is a mechanism to amplify your gain and losses. If you bought euro with 10x leverage and it went up 5%, you will make 50%. Likewise, if it went down 5%, you will lose 50%. So, our suggestion is to avoid leverage when investing in foreign currency. And if you do that, you will be fine. So let's move on to the last topic, which is commodity. There are three types of commodities: replenishable commodities, energy-related commodities, and then there are the metal commodities. Replenishable commodities are typically agricultural products like meat, corn, wheat, and more. Their prices generally fall over time because technology is making them cheaper to produce. The only time that you want to invest in them is when some event causes a shortage in supply. Now, the next type of commodity are energy-related commodities like crude oil and natural gas. Oil is special because it is a controlled, non-replenishable commodity. Basically, oil price is based on the supplier policy, namely OPEC. It is in OPEC's interest to always drive oil prices up and make the price stable. It can be a good investment for 1 to 3 years time frame, but it can be very volatile. If you look back in 2014 or 15, there has been a huge drop in oil prices. At the end, we have metal commodities. There are two categories of metal commodities. The first one is precious metal and industrial metal. Gold is the most popular metal commodity. Gold price is determined by the value of a country's currency. If a country's currency goes down, gold price in that country would go up. So let me repeat that again. If a country's currency goes down, gold price in that country would go up. Okay? I will skip the process of explaining the mechanism of this because it is quite a complicated concept. You can try Googling why that is the case. So, to repeat myself again, when a country currency goes down, gold prices in that country would usually go up. On the other hand, we have industrial metal like lithium. They are purely driven by supply and demand. Since electric cars are gaining popularity, lithium prices has been on the rise. Unfortunately, supply for lithium is going to be limited, just like oil. So it is fair to expect that the price of lithium will keep going up. With this, we will end the discussion on asset classes. Our next lesson will be on stocks and bonds, so make sure you don't miss that lesson. I'll see you soon.